Imagine a scenario that, thankfully, you did not have to live through today. You wake up, you open your banking app to pay your mortgage, and the screen is just blank.
Yeah, total panic.
Right. Not just a glitch, but like a fundamental failure. You try to sell a few shares of stock to cover the cash, but the sell button just does absolutely nothing.
Which is terrifying.
Exactly. And across the country, a factory manager tries to draw down a line of credit to make payroll, and the bank simply says, we don't have the funds.
Complete system failure.
Yeah, a complete cardiovascular collapse of the global economy.
Mm-hmm.
And the wild part is, that is always about 3 days away, if not for a massive, invisible, high-speed nervous system pulsing beneath, well, literally everything we do.
It is the ultimate paradox of modern life, really. I mean, the infrastructure that keeps food on the shelves, businesses running, retirements funded it, is entirely invisible to the people who rely on it the most.
We just take it for granted.
Oh, absolutely. Yeah. We only ever look at the plumbing when the pipes burst, like we saw during the 2008 financial crisis.
Which is an incredibly terrifying thought. Because, we all interact with money. You earn it, you save it, you invest it. But the moment it leaves your digital wallet, it enters this vast labyrinth.
It really does.
And today, our mission for this deep dive is to map that labyrinth. We are tearing down the drywall to look at the pipes.
I love that analogy.
Thanks. We are diving deep into the absolute bedrock of this invisible system, and we are using a very specific, incredibly detailed blueprint today. It is Chapter 2, Introduction to Securities Markets, from the National Institute of Securities Markets, or NISM, specifically their Series XIKA workbook.
Right.
Which is the literal training manual for portfolio management services distributors in India.
And it is such an essential text because it totally refuses to romanticize the market.
Right. No Wall Street movie glamour here.
Exactly. It doesn't treat investing as gambling or like some kind of magic. It breaks down the rigid, compartmentalized machinery that allows capital to flow without grinding to a catastrophic halt.
Which is super important for everyone to understand.
It really is. Understanding this is not just for aspiring fund managers. Yeah. If you are trusting your life savings to this system, you really need to understand the mechanics of the vault you are putting it in.
Spot on. So we are going to track a single rupee. We're going to follow your surplus savings from the moment it leaves your household, watch it transform into raw fuel for a business in the primary market.
A fascinating process.
Feel the sheer panic and velocity of the secondary trading market. And finally, meet the gatekeepers, the literal multi-billion-dollar sentinels that guarantee the whole thing doesn't collapse.
It is a wild journey.
So let's start at the absolute beginning. The text says, the entire securities market exists to solve one fundamental problem, which is the mismatch of capital over time.
Yeah.
Break that down for us. Why is my perfectly fine savings account a structural problem for the economy?
Well, it isn't a problem per se. It is more like half of an equation. Think about the economic life cycle of a typical household. You experience distinct phases, right? In your early 20s, or say when you buy your first home, you are in a deficit phase.
Because I am spending way more than I make.
Exactly. You consume more capital than you produce. But eventually, you hit your peak earning years, you pay down the debt, your income rises, and suddenly you have a surplus.
Right.
You are producing more capital than you consume, and that surplus cash basically just sits idle.
Right. I'm stockpiling for retirement. It's just sitting there in the bank.
Now look at a business enterprise. By its very nature, a growing business is in a perpetual deficit phase.
Always needing cash.
Always. If an auto manufacturer wants to build, say, an electric vehicle plant, they need billions of rupees today to build the factory, hire the engineers, source the lithium, all before they sell a single car 5 years from now.
That makes sense.
So they have an acute productive need for capital. You have idle capital. The securities market is essentially the highly regulated bridge built between your idle surplus and their productive deficit.
Okay, I understand the matchmaking aspect, but here is where I need to push back a little bit.
Go for it.
Why do we need this hyper-complex trillion-dollar securities market with, flashing screens and shouting traders to act as a bridge? I have a bank account. I put my surplus in the bank. The auto manufacturer goes to my bank and asks for a loan. The bank moves the money. Why isn't that just enough?
Well, because relying solely on banks creates a massive systemic bottleneck. And frankly, it fundamentally caps your potential wealth.
How so?
When you put your surplus in a bank, the bank assumes 100% of the risk of lending it out. To compensate for that risk, they offer you a fixed relatively low interest rate, let's say 4%.
Standard savings rate.
Then the bank turns around and lends your money to that auto manufacturer at 9%. The bank simply pockets the 5% spread.
So the bank is taking all the upside,
Exactly.
but they are also eating the loss if the auto manufacturer goes bankrupt, right?
Correct. They take the risk, they get the reward. But what if you don't want a 4% return?
Yeah, I want more.
Right. What if you are 30 years old, you have an appetite for risk, and you want a piece of the auto manufacturer's actual profits?
Okay, I see where this is going.
Or conversely, what if the auto manufacturer doesn't want it tied down by a restrictive bank loan that drains their monthly cash flow with brutal interest payments?
Because loans require monthly payments no matter what.
Exactly. The securities market bypasses the bank entirely. It allows the business to reach out to millions of investors directly and say, hey, give us your surplus, and in exchange, we will give you a security.
A security. Now, the workbook spends a lot of time defining this word. It's not just a stock.
No, it is much broader.
Right. It points to Section 2 of the Securities Contracts Regulation Act of 1956. And it delivers this, frankly, intimidating laundry list of instruments.
It is quite a list.
Yeah. I need you to translate these because the text assumes I already know what they are. It lists shares, scrips, stocks, bonds, debentures, derivatives, mutual fund units, and securitization receipts.
Okay, let's unpack that.
Let's start with the basic contrast, right? Shares versus bonds. What actual rights am I buying?
So fundamentally, a security is just a legally binding term of exchange. When you buy a share, you are buying a tiny mathematical slice of ownership.
Okay.
You aren't guaranteed a single rupee in return, but you get a permanent claim on the company's future profits, usually paid as dividends, and you get voting rights. You are a part owner.
Okay, so that is pure equity. I win if they win, I lose if they lose.
Exactly.
What about a bond or a debenture?
When you buy a bond or a debenture, you are acting as the bank. You are a lender.
Oh, I see.
The company legally obligates itself to pay you a fixed interest rate every year and return your principal on a specific date. You get no voting rights, and you don't share in their record-breaking profit.
So no upside beyond the interest.
Right. However, in the capital structure, debt is senior to equity.
What does that mean in practice?
If the company goes bankrupt, the bondholders get to liquidate the factory and take their money back first. The shareholders only get what is left over, which is usually nothing.
Wow. Okay, that makes complete sense, the classic risk-reward trade-off. But what about securitization receipts?
Oh, those are fascinating.
That sounds like a receipt I get from a toll booth. What on earth is that?
This is where financial engineering gets really interesting. Let's go back to the bank for a second. A local bank issues 1,000 home mortgages. Those are illiquid assets, right? The bank is stuck waiting 30 years to get its money back.
30 years is a long time to wait for your cash.
Exactly. But the bank wants cash today so it can make more loans. So an investment bank comes along, buys all 1,000 of those boring 30-year mortgages, bundles them together into a giant pool, and then slices that pool up into thousands of individual pieces.
Wait, so they turn a localized pile of debt into a tradable product?
Exactly.
Right.
When you buy one of those pieces, you receive a securitization receipt. You are now buying the right to receive a fractional slice of the monthly mortgage payments from those 1,000 homeowners.
Yeah, it is wild.
It transforms an illiquid private loan into a highly liquid, publicly traded security.
Okay, and derivatives. The text specifically mentions commodity derivatives. What are those?
Well, a derivative doesn't have intrinsic value. It derives its value from an underlying asset.
Okay, give me an example.
Imagine a wheat farmer who is terrified the price of wheat will crash before the October harvest, and a bread manufacturer who is terrified the price of wheat will skyrocket.
Two opposite fears.
Right. The securities market allows them to sign a derivative contract today, locking in a specific price for October. They trade the risk of the asset without trading the physical wheat itself.
So all of these instruments, shares, bonds, securitized mortgages, derivatives, they are basically a bespoke menu.
Exactly.
Instead of a one-size-fits-all bank deposit, I can curate my exact flavor of risk, return, and duration.
Precisely.
But before I can trade these on an app, they have to, well, come into existence. The company has to actually issue them. And this takes us to the birthplace. The primary market.
Yes. The primary market is the only time the issuing company actually looks the investor in the eye, so to speak.
Right.
The primary function of this market is capital formation. It is about bringing entirely fresh, new money into the company's treasury.
Okay, let's walk through the doors of this birthplace. The most famous mechanism here is the initial public offer, the IPO.
Everyone knows the IPO.
Right. This is a company's debut to the public.
Yeah.
But the workbook makes it clear that SEBI, the regulator, doesn't just let anyone do an IPO. You have to prove you are worthy of taking the public savings.
Oh, absolutely. And the barriers to entry are intentionally brutal. SEBI demands a multi-year track record of profitability. They require a minimum net worth. And crucially, they require a minimum amount of net tangible assets.
Net tangible assets, meaning physical stuff you can touch, not just like a clever idea and a sleek logo.
Exactly. A software startup might be valued at $1 billion based on its algorithms, but if things go completely wrong, an algorithm cannot be liquidated to pay back retail investors.
Yeah, you can't auction off a line of code.
Right. SEBI historically wanted to see factories, land, inventory things with a tangible floor value. Now, the rules have evolved slightly for tech companies, but the core philosophy remains.
Which is?
The primary market is an engine for funding substantial, proven enterprises, not wild speculative bets.
Let's assume our auto manufacturer passes the test and does an IPO. They raise ₹1 billion of fresh capital. 5 years later, they want to build a second factory. They are already a public company. What do they do then?
They execute a further public offer, or FPO.
An FPO, okay.
It functions exactly like an IPO, but the market already has a daily price for the company's shares. They issue new, additional shares to the public to drag a second wave of fresh capital into the treasury.
Okay, so IPOs and FPOs are for the general public. But what if the company doesn't want to deal with the general public?
It happens all the time.
What if printing glossy prospectuses and doing a 3-week roadshow is just way too slow? The workbook details private and selective issues. It specifically mentions private placements under the Companies Act of 2013. How does this bypass the IPO circus?
Well, a public issue is incredibly cumbersome. If an established company suddenly needs 500 million rupees to acquire a rival, they might not have 6 months to wait for SEBI approvals.
Yeah, business moves fast.
Under the Companies Act, if a company offers securities to less than 200 specific persons, it is legally classified as a private placement. Because it's not a broad solicitation of retail savings, the regulatory friction drops dramatically.
Less than 200 people. So they just call up a few massive private equity firms or billionaires and negotiate behind closed doors.
Pretty much.
The text also mentions preferential issues and QIPs, qualified institutions placements. What is a QIP doing differently?
A QIP is a phenomenal tool for an already listed company. They want to issue new shares to raise cash fast, but they only target qualified institutional buyers, or QIPs.
And who are they?
These are mutual funds, commercial banks, and massive insurance companies.
Wait, so they are actively excluding me, the retail investor?
Yeah.
Why does SEBI allow a public company to just ignore the retail public when issuing new shares?
Because of the assumption of financial sophistication,
Okay.
SEBI's primary mandate is to protect you, the retail investor, because you might not fully grasp the risks of a sudden corporate acquisition. A massive commercial bank, however, has armies of analysts.
They can read a balance sheet.
Exactly. They don't need SEBI to hold their hand. By restricting the offer strictly to QIBs, the company can issue the shares, raise billions of rupees, and close the deal in 48 hours instead of 6 months.
That is a staggering advantage. Speed is a currency in itself. But what about the existing shareholders? Let's say I bought shares in the IPO. I own 10% of the auto manufacturer. If they suddenly issue millions of new shares to a bank in a QIP, my 10% slice of the pie just shrank to 5%. My voting power is diluted. How is that fair?
This is exactly why the rights issue mechanism exists.
Oh.
Before a company can arbitrarily issue new equity to outsiders, they often must offer preemptive rights to existing shareholders. If you own 10% of the company and they want to issue 1 million new shares, they are legally obligated to send you a letter offering you the right to buy 100,000 of those new shares first.
Okay, let me walk through a painful scenario here. I get that email from my broker about a rights issue, and I ignore it. I don't open the attachment. I don't buy the new shares. What happens to me?
You suffer immediate mathematical dilution.
Ouch.
The company issues those shares to someone else. The company now has a larger total number of shares in existence, but the total value of the company hasn't necessarily increased proportionally yet. Your 10% voting power immediately drops, and your claim on future earnings per share decreases.
So a rights issue forces the investor to make a choice.
Yes, put more money into the company to maintain your percentage, or sit on your hands and watch your ownership shrink.
It's basically a mandatory pay-to-play mechanic if you want to keep your influence.
Fascinating. Okay, I need to challenge you on the next term in the workbook because it sounds like a complete contradiction.
Right.
The bonus issue. The text says, a company can give out free additional shares to existing shareholders by capitalizing their free reserves. But it explicitly states that this does not increase the company's net worth. Let me be blunt. If someone hands me something called a bonus, I expect to be richer. If the net worth doesn't change, this is a fake bonus.
I completely understand the skepticism. It sounds like a trick. To grasp a bonus issue, we really have to look at the balance sheet.
Okay, paint the picture.
Imagine a company has 10 million rupees in its foundational equity capital account and 50 million rupees sitting in a free reserves account.
What are free reserves?
Basically retained profits from past years that they haven't paid out as dividends. Now, they decide to capitalize those reserves.
Meaning what exactly? They do an accounting entry. They move 10 million rupees out of the free reserves and lock it permanently into the equity capital account. To represent that new permanent capital, they print new shares and hand them out to the existing shareholders for free. Let's say they do a one-for-one bonus. For every share you own, they hand you another one.
Okay, so I have double the shares, but you still haven't explained why I'm not richer.
Think of a crisp 100 rupee note in your wallet. That represents the value of your single share. The company walks up to you, takes your 100 rupee note, and hands you two 50 rupee notes. You mathematically possess more individual pieces of paper, more shares, but your total wealth is completely unchanged. The day the bonus shares are issued, the stock exchange artificially slashes the share price exactly in half to reflect the new reality.
If the math is completely neutral, why go through the charade? Why waste everyone's time trading a 100 rupee note for two 50s?
For two highly strategic reasons, extreme liquidity and psychological bias. Let's say a spectacularly successful company hasn't split its shares in years. The price of a single share balloons to 80,000 rupees.
Which means a normal retail investor with a monthly SIP of 10,000 rupees literally cannot afford to buy a single share. They are priced out of the asset entirely.
Precisely. The stock becomes illiquid. It's only traded by whales. By issuing a 10-for-1 bonus issue, the company artificially forces the price down to 8,000 rupees per share. Suddenly, millions of retail investors can afford to buy it. Liquidity floods back into the stock.
Okay, that is brilliant. And what about the psychological bias?
Markets are driven by human emotion. Investors love receiving free shares, even if it's an illusion. More importantly, it signals incredible corporate confidence.
How so?
A company is permanently locking its cash reserves into its equity base. It's essentially shouting to the market, we are so confident in our future cash flows that we don't need this buffer anymore. That's why the workbook explicitly notes that a company is strictly forbidden from issuing bonus shares if it has defaulted on any debt payments.
Yeah, you can't pretend to be financially robust while missing your mortgage payments. That makes a lot of sense. Now, there is one more primary market term that seems like an imposter, the offer for sale, or OFS.
Yes.
The workbook says this is when existing large shareholders sell their already allotted shares to the public, but the proceeds go to the sellers, not the company. How is this primary capital formation if the company doesn't get a dime?
It isn't primary capital formation. You've spotted the anomaly. An offer for sale is technically a massive secondary market transaction. A classic example is when the government of India decides to disinvest its stake in a massive public sector undertaking, like the life insurance corporation.
Right. The government owns 100%, and they want to sell 5% to the public.
Exactly. The government is selling its own shares. The thousands of crores raised go directly into the government's tax coffers, not into the LIC treasury.
Okay, so why is it in the primary market section?
Because you are trying to sell hundreds of millions of shares at once. You cannot simply dump them on the regular stock exchange on a Tuesday morning. The sheer volume would crash the price to zero. You have to use the infrastructure of the primary market, the road shows, the merchant bankers, the fixed price bidding windows to facilitate a transaction of that scale.
So it's using a specialized birth canal for an adult asset.
That is a very visceral way to put it, but yes.
Okay, we've birthed the securities, we've raised the capital, but here's the reality. I am never, ever going to buy an IPO share if I am legally chained to it until the company goes bankrupt or I die. I only buy it because I know I can sell it,
Absolutely.
which means we must leave the primary market and enter the secondary market.
The secondary market provides the ultimate oxygen to the primary market, which is liquidity. The secondary market is where already issued securities are traded between investors. The issuing company is completely detached from these transactions.
So the auto manufacturer doesn't care if I sell my shares to you.
Right. They already have their money. The workbook divides this into two distinct ecosystems: over-the-counter, or OTC markets, and exchange-traded markets.
Let's start with OTC. The text says these are directly negotiated. This sounds to me like buying a used car on Craigslist.
That is a very apt comparison. In an OTC market, the trade is bilateral. A hedge fund calls up a massive commercial bank directly and says, "We want to buy 2 billion rupees worth of unlisted corporate bonds."
I'll just over the phone.
They negotiate the price over the phone or a proprietary network, and they execute the swap. It is customized, it is opaque, and it is entirely dependent on bilateral trust.
Bilateral trust. Meaning I have to trust that the guy on the other end of the phone actually owns the bonds, and he has to trust that my wire transfer isn't going to bounce.
Correct.
That seems wildly inefficient for millions of retail investors, which is why the bulk of what we call the stock market happens on the exchange-traded markets.
Exchange-traded markets remove the necessity of trust. They standardize everything. You aren't negotiating terms. You're trading standardized contracts on a centralized electronic platform.
Okay.
And to understand how this removes trust from the equation, we really have to dissect the trade life cycle. That is, trading, clearing, and settlement.
Let's walk through it step by step. I sit at my desk, I open my brokerage app, and I click buy 1,000 shares of Tata Motors at 950 rupees. What is the trading phase?
Trading is simply the execution of the formal contract. Your broker server sends your order to the massive matching engines at the National Stock Exchange. Within microseconds, the algorithm finds someone else who clicked sell 1,000 shares at 950 rupees. The exchange locks those two orders together. The trade is executed.
But I don't have the shares yet, and the seller hasn't been paid.
Correct. The trade is just a binding promise. Next comes clearing. At the end of the trading day, the clearing algorithms process the millions of trades that happened. They ascertain the net obligations.
Net obligations. Explain that.
Say broker A bought 10,000 shares for various clients, but also sold 8,000 shares for other clients. The clearing system calculates that broker A's net obligation is only to deliver cash for 2,000 shares.
Oh, that is smart. It drastically reduces the actual movement of assets. And then settlement.
Settlement is the actual physical or digital finality. The day the digital shares are officially transferred into your account and the seller's bank account is credited with the cash. In India, this happens on a T+1 basis, trade day plus 1 business day.
But this brings up the most terrifying vulnerability.
It is.
Let's say I click buy for a massive block of shares. The exchange matches me with a seller. The trade is executed. But during the clearing phase, before settlement happens, the seller's brokerage firm goes completely bankrupt.
It happens.
They literally don't have the shares to give me. If this is an OTC market, I'm just screwed, right? I'm tied up in bankruptcy court for a decade.
Oh.
But the workbook introduces the superhero of the exchange-traded market, the clearing corporation, and a concept called novation. I need you to explain novation, because the text makes it sound like legal magic.
It is arguably the most brilliant structural innovation in the history of finance. Novation is the legal act of replacing one contract with another.
How does that work in my scenario?
The moment the matching engine pairs your buy order with the seller's sell order, the clearing corporation steps directly into the middle of the transaction. It instantly severs the legal link between you and the actual seller.
It cuts the wire.
It cuts the wire. The clearing corporation legally becomes the buyer to the seller and the seller to the buyer. You are no longer buying shares from some random guy in Mumbai. You're buying shares directly from the multi-billion-dollar Central Clearing Corporation.
Wow.
And the seller is selling directly to the clearing corporation. They provide an absolute ironclad guarantee of settlement. If that original seller goes bankrupt an hour later, you don't even know it happened. The clearing corporation will go into the open market, buy the shares with its own money, and deliver them to your account on time.
Okay, that is incredible for me as an investor. I have zero counterparty risk. But let me push back forcefully on the mechanics here.
Okay, what's the issue?
This sounds like an apocalyptic systemic risk for the clearing corporation. They are legally stepping into the middle of millions of trades worth billions of dollars every single day. If a massive hedge fund defaults on a massive derivatives trade, the clearing corporation is legally on the hook for the loss. How do they not go bankrupt? Are they just blindly trusting that the market won't crash?
Not at all. This is exactly why the clearing corporation operates the most ruthless risk management system on the planet. They do not rely on trust, they rely on margins, they operate a mathematical fortress.
How does the fortress work?
Before any broker is even allowed to connect to the exchange and place a trade for a client, the clearing corporation demands an initial margin, paid upfront in cash or high-quality liquid assets.
Like a massive security deposit before you can rent the apartment.
Yeah.
How do they calculate how much deposit they need?
They use sophisticated value at risk, or VAR, models. They look at the specific security being traded, calculate its historical volatility, and estimate the maximum possible loss that security could suffer in a single day under a 99% worst-case scenario.
Okay.
If a stock is wildly volatile, the initial margin demanded is brutally high. They hold this cash as a shield.
But what if the market drops more than the VAR model predicted? A true black swan event.
That is where the second layer of defense activates. Mark-to-market, or MTM, margins.
Walk me through that.
Let's walk through a painful, concrete scenario. It is 10:00 a.m. You buy a futures contract tied to the stock index, heavily leveraged. At 2:00 p.m., catastrophic news hits the wire. The market tanks. Your futures contract is suddenly severely underwater.
But I haven't sold it yet. It's just a paper loss.
The clearing corporation does not care that it's a paper loss. They view that notional loss as a direct threat to their survival. At the end of every single trading day, they mark every single open position to the current closing price.
Oh, I see.
If you have a notional loss of 500,000 rupees, the clearing corporation will issue a margin call to your broker. They demand that 500,000 rupees in hard cash be deposited into their accounts before the market opens the next morning.
And if I ignore the phone call from my broker? If I literally don't have the cash?
If the cash is not there by the deadline, the clearing corporation's automated risk systems will take control of your account and ruthlessly liquidate your position at the opening bell.
They just sell it.
They will sell your contract at a loss to stop the bleeding before it gets worse. They do this to protect the structural integrity of the entire national market. Their ruthlessness is the only reason the magic of novation works.
Wow. It's a flawless, unfeeling machine. But executing millions of novated trades, tracking VAR models, moving the cash, transferring the digital shares, this requires a massive physical infrastructure.
Yeah.
Who are the mechanics maintaining this arena? This brings us to the compartmentalized ecosystem the workbook calls market infrastructure institutions and intermediaries.
Right. This is where we see the intentional fragmentation of power. The market is designed so that no single entity holds all the keys.
To prevent fraud.
Exactly. If one entity held the shares, matched the trades, and held the cash, the potential for catastrophic fraud would be absolute. Therefore, we have compartmentalized gatekeepers.
Let's run down the cast of characters. First, the stock exchanges. The NSE, the BSE, they are the actual stadiums. They run the fiber optic networks and the matching algorithms. But crucially, the exchange itself doesn't hold my shares right.
Correct. The exchange is just a venue for price discovery and trade execution. The actual assets are held by the depositories.
Depositories. The workbook highlights NSDL and CDSL in India. Let's dive deep here because the transition from paper to digital is a huge part of market history.
30 years ago, if you bought a stock, a company physically mailed you a piece of paper with a wax seal. If your house burned down, your wealth burned with it.
That sounds like a nightmare.
It was. If you wanted to sell, you had to mail the certificate back to the company registrar, hope it didn't get lost in the post, and wait weeks for signature verification. It was a nightmare of bad deliveries and forgery.
So the depository was created to digitize the wealth. Dematerialization.
Exactly. Depositories are the central, impenetrable digital fortresses of the market. They hold the ultimate master electronic ledger of who owns what. Every share, bond, and ETF is dematerialized into a digital entry in their massive mainframes.
Okay, but if I want to check my balance, I can't just drive up to the CDSL headquarters, knock on the glass, and ask a security guard to look up my account. They don't deal with the public.
No, dealing with tens of millions of retail investors would paralyze them. The depository operates strictly at the wholesale level. To access your digital safe deposit box inside that fortress, you must go through a depository participant, or DP.
This is my local broker or my bank.
Yes. The DP acts as the authorized agent. They undergo strict SEBI audits to ensure they have the secure technological links to interface with the depository.
So the app I use isn't the actual vault.
Right. When you log into your banking app and look at your portfolio, the interface belongs to the DP, but the data is being pulled securely from the master vault at the depository.
So we have the exchange matching the trade and the depository holding the digital asset. What about the people executing the trades? The trading members and authorized persons?
A trading member is a stockbroker. They are corporate entities that have paid massive membership fees and deposited huge capital reserves to connect their servers directly to the stock exchange's matching engine.
So I can't do it myself.
No, as a retail investor, you legally cannot connect to the NSE. You must route your order through a broker's terminal.
And the authorized persons. The text mentions them as agents of the brokers.
India is a vast geographic market. A major brokerage firm headquartered in Mumbai might want to acquire clients in a small Tier 3 city. Instead of opening an expensive branch, they license a local financial advisor to act as an authorized person.
Ah, like a franchise.
Exactly. The AP acts as the local face, acquiring clients and providing customer service, while all the actual trading and compliance flow through the main broker's infrastructure.
Compartmentalization. It's beautiful. But the workbook introduces another tier that seems redundant to me. Custodians. It says they safeguard securities for institutional investors.
Yeah.
Why does a massive foreign pension fund need a special custodian? Why can't they just use a regular broker and a DP like I do?
Because of the sheer horrifying complexity of their operations. Imagine you are a Norwegian pension fund. You hold 50 billion rupees in Indian equities spread across 400 different companies.
Okay.
Every single day, corporate actions are happening. Company A is doing a 1-for-2 bonus issue. Company B is doing a rights issue that you need to calculate whether to subscribe to. Company C is paying a dividend, but because you are a foreign entity, the withholding tax calculation is a nightmare.
A retail broker software would completely break down trying to manage that.
Absolutely. A custodian is essentially a hyper-powered, institutional-grade depository participant combined with an army of accountants and tax lawyers.
Wow.
They physically safeguard the assets, clear the institutional trades, collect the dividends, process the complex cross-border taxes, and vote the proxy shares at annual general meetings. They are the logistical backbone for the whales of the market.
Which perfectly transitions us to the final piece of the plumbing, the clearing banks. We know the depository moves the digital shares, but someone has to move the actual cash to complete the settlement.
Right. The clearing corporation doesn't store cash, it manages risk. Every single registered broker is required by law to maintain a dedicated account with a designated clearing bank.
Okay.
When the T+1 settlement hour arrives, usually early afternoon the day after the trade, the clearing corporation sends an electronic file to the clearing bank.
And that file says, Broker A owes 50 million rupees. Broker B is owed 50 million rupees.
Exactly. And the clearing bank executes a massive instantaneous debit and credit across all the broker's accounts simultaneously. The money is moved precisely as the depository moves the digital shares.
That is amazing.
The synchronization is flawless. If a broker doesn't have the funds in their clearing bank account at that precise millisecond, the alarms go off and the risk management protocols we discussed earlier kick in immediately.
It is a synchronized ballet of immense proportions. Exchange matches, clearing core guarantees, depository moves the asset, clearing bank moves the cash. Now, before we leave the intermediaries, I have to clear up one major point of confusion from the text.
Sure.
Merchant bankers, are they just fancy brokers?
No, they occupy completely different universes. A standard stockbroker operates almost exclusively in the secondary market, the fast-paced world of trading already existing shares. A merchant banker operates almost exclusively in the primary market, the slow, grueling world of creating new shares.
The birthplace we talked about earlier.
Yes. When our auto manufacturer decides to do an IPO, they don't hire a guy with a trading terminal. They hire a merchant banker as the lead manager.
What do they actually do?
The merchant banker spends 6 months holding the company's hand. They conduct the due diligence, draft the 500-page prospectus for SEBI, orchestrate the nationwide marketing roadshow, and critically, they help the company determine the pricing band for the new shares.
They are the architects of the IPO. But once the IPO is finished and the stock is ringing the bell on the exchange,
the merchant banker's primary job is done. They step back, and the secondary market brokers take over the daily chaos of trading.
Got it. Okay, we have the matchmaking blueprint. We know how securities are born in the primary market. We know how they are securely traded in the secondary market via novation. And we've met the gatekeepers running the arena. The final piece of the puzzle, Section 5 of the workbook details who is actually playing the game.
The participants.
And the scale difference between the players is staggering.
It is a market of minnows swimming alongside leviathans. And the leviathans are the institutional investors. These are massive pools of capital that dictate the fundamental flow of the market.
The workbook lists a fascinating array of these institutions. Let's unpack the motivations of a few of them. It mentions commercial banks. We know they lend money. But why are they playing in the securities market?
Banks operate massive treasury departments. When you deposit cash, a bank can't always lend 100% of it out as a 30-year mortgage. They need liquid reserves to meet daily withdrawal demands.
Right.
But keeping billions in cash sitting in a vault loses value to inflation every single day. So, bank treasuries actively invest in highly liquid government securities and high-grade corporate bonds. They use the securities market to earn a yield on their mandatory safety buffers.
Then we have mutual funds and pension funds. The Employees Provident Fund Organization, or EPFO, or the National Pension System. These aren't just rich guys, this is everyday money.
This is the aggregate weight of the working class. An individual retail investor might only have 5,000 rupees a month to invest. But when a mutual fund or a pension fund aggregates that 5,000 rupees from 20 million salaried employees, they suddenly command billions.
What is their goal?
Their motivation is long-term, compounding growth to outpace inflation so that when those workers retire in 30 years, the purchasing power of their savings has survived.
The text also points out insurance companies. They are massive players.
Think about a life insurance business model. They collect thousands of rupees in premiums from you every year, but they likely won't have to pay out a death benefit for 40 years.
So they just sit on it.
They are sitting on a mountain of capital called a float. They must invest that float aggressively in the securities market so it grows large enough to cover the actuarial certainty of future payouts.
But the two institutional players that really caught my eye in the text, the ones that seem to be evolving the fastest, are corporate treasuries and family offices. Let's start with corporate treasuries. I always assumed a corporate treasurer was essentially just a chief accountant, making sure the corporate checking account didn't bounce when payroll was due.
That was true 30 years ago. The workbook highlights a massive evolutionary shift. Corporate treasuries at massive conglomerates, say a multinational tech firm or an energy giant, are no longer just risk managers. They have transformed into active, aggressive profit centers.
How does that work? If I'm an energy company, my profit center should be selling oil, not trading stocks.
Let's say the energy company has a spectacular quarter and is sitting on $5 billion of surplus cash. If the treasurer just leaves that in a checking account, the CEO will fire them.
Because of inflation.
Inflation is eating it alive. Instead, the modern corporate treasury behaves like an internal hedge fund. They actively navigate the yield curve.
Explain the yield curve. That's a term thrown around on financial news all the time.
A yield curve is simply a graphical line that plots the interest rates of bonds with different maturity dates. Normally, if you lock your money up for 10 years, you demand a higher interest rate than if you lock it up for 3 months. The curve slopes upward.
Okay.
A brilliant corporate treasurer maps this curve. They calculate exactly when the company needs cash to build their next refinery. If they need the cash in exactly 18 months, they will aggressively buy 18-month corporate bonds yielding 6% rather than leaving it in a bank overnight account yielding 2%.
Oh, wow.
They are actively minimizing the company's cost of capital by wringing every possible drop of yield out of their idle cash.
That is brilliant. They are weaponizing their surplus. And the other entity, family offices.
A family office is a fascinating structure. When a founder takes their company public and suddenly possesses a net worth of $2 billion, they don't just open a premium account at a retail bank. They legally incorporate an entirely private financial institution, a family office.
So it's an institution dedicated entirely to managing the wealth of one bloodline.
Exactly. They hire their own elite portfolio managers, their own tax attorneys, their own private equity analysts. They bypass retail mutual funds entirely and invest directly in venture capital, real estate syndications, and complex derivatives.
That is a whole different level.
They act as a sovereign wealth fund for a single family, designed not just to grow wealth, but to ensure it survives taxation and inflation for 5 generations.
Those are the leviathans. And then, at the very bottom of the food chain, swimming amongst the whales, is the retail participant, you and me. Individuals trading for our personal accounts. But the SEBI definition of a retail investor, specifically in the context of participating in primary market IPOs, is incredibly rigid.
It is a strict mathematical threshold.
The workbook says a retail individual investor is someone who bids for a value of not more than 2 lakh rupees in a single issue. Let me push back on this because it seems deeply arbitrary.
Yeah.
Let's say an exciting tech IPO is launching. I bid exactly 1,099,999 rupees. I am legally a retail investor. I am sheltered. I am protected. But if I find a 2 rupee coin in my couch cushions and I increase my bid to 2,001 rupees, I cross the invisible line. Does SEBI suddenly view me as a sophisticated multi-billion-dollar hedge fund? That makes no logical sense.
It's not that SEBI views you as a hedge fund. It's about maintaining a protective quota system. When a highly anticipated IPO happens, the massive institutional funds we just talked about, the QIBs, want to buy the entire offering. They have the capital to absorb every single share on day one.
Oh, I see.
If SEBI didn't intervene, the everyday citizen would never get a chance to participate in the wealth creation of a booming public company.
The whales would eat all the food.
Exactly. So SEBI mandates a strict quota. They say to the company, a minimum percentage of this IPO, often 35%, must be explicitly reserved in a locked bucket exclusively for small retail investors. The 2 lakh rupee line is drawn to define that bucket. It ensures that a wealthy individual can't swoop in and buy up the entire retail allocation.
Ah, so it's a structural defense mechanism.
Yes. When you bid 2,001 rupees, you are bumped out of the protected retail bucket and reclassified as a non-institutional investor, or an HNI, a high net worth individual. You aren't treated as a qualified institutional buyer. You don't get the VIP treatment of a bank, but you lose the shelter of the retail quota.
Interesting.
The regulator draws a hard line under the assumption that if you can casually risk more than 2 lakh rupees on a single speculative IPO, you possess a higher capacity to absorb potential losses, and you likely have access to professional financial advice. The regulator's primary job is to protect the vulnerable bottom of the pyramid.
It's a blunt instrument, but a necessary one to balance fairness against the sheer gravitational pull of institutional money.
Oh.
Okay.
Yeah.
We have mapped the entire labyrinth. We have covered an immense amount of ground today based on this single chapter.
Yeah.
Let's do a fast recap of the journey.
We started with the macro perspective, the fundamental mismatch of capital. Your household surplus savings seeking a productive home, and corporate deficits desperate for raw fuel.
We watched that capital meet in the primary market, the birthplace, where a company proves it has the net tangible assets to be worthy of public trust, and issues new security shares, bonds, securitization receipts to drag fresh capital into its treasury.
We then followed those newly birthed securities into the violent high-speed arena of the secondary market, but we realized the chaos is highly controlled.
Right, the magic of novation.
The clearing corporations stepping into the middle of every trade, acting as an invincible counterparty, but demanding brutal upfront margins to protect the system from default.
We looked under the hood at the fragmented gatekeepers, the digital fortresses of the depositories holding the dematerialized assets, the clearing banks moving the massive settlement cash, the custodians managing the logistical nightmares for foreign funds.
And finally, we looked at the players on the field. The stark contrast between the strictly regulated, quota-protected retail investor with their 2 lakh limit and the massive, aggressive institutional whales.
The mutual funds, the insurers, the yield curve navigating corporate treasuries. They drive the sheer volume of the global economy.
It really is a breathtaking piece of engineering.
It is. But looking at all these rigid compartments and hearing you describe the evolution of corporate treasuries, it makes me wonder about the future of this blueprint. And that brings me to a final thought for us to ponder.
Okay.
The workbook describes a highly structured, rigid system designed to clearly separate the vulnerable retail investor from the sophisticated institutional pool. The rules are built entirely around this segregation.
Yes, the 2 lakh boundary line.
But look at what is happening with technology right now. The line between retail and institution is blurring at terrifying speed. Retail investors aren't just buying single stocks anymore. They are pooling trillions of rupees into these massive mutual funds via daily SIPs, effectively wielding institutional weight by proxy.
That is very true.
Furthermore, the retail investor sitting in their bedroom now has access to algorithmic trading APIs, AI-driven options analytics, and fractional share execution. They possess the technological capability to navigate the markets with the aggression and speed of a family office.
It completely upends the foundational assumption of the regulator.
Exactly. If the entire invisible architecture relies on this rigid categorization on treating retail like vulnerable minnows and institutions like sophisticated whales. What happens when the minnows arm themselves with institutional tools and swarm the market?
That is a scary thought.
Does the risk management of the clearing corporation hold up when millions of algorithmic retail accounts simultaneously trigger VAR margin calls during a panic? Do the traditional boundaries of market participants need to be fundamentally redrawn? The blueprint we study today is brilliant, but it feels like the inhabitants of the building are mutating faster than the architects can pour concrete.
That is the ultimate question for the next decade of market regulation. The infrastructure is robust, but it was designed for a clear hierarchy that technology is rapidly destroying.
And that is exactly why we need to keep examining the plumbing. The invisible architecture is constantly shifting beneath our feet. Keep questioning how your money moves through the world. Keep looking past the flashing red and green numbers on your screen to the machinery underneath, and we will catch you on the next deep dive.